Welcome back to Finance in Motion. My name is Adamo, your personal financial planner, and as always, my goal is to help build your wealth and help you sleep well at night. In this video, this is the third installment of the Building Your Wealth for Your Kids, known as the Permanent Critical Illness Strategy. Okay, so in the first installment of the series, we saw the RESP to build wealth for our kids and grandkids. In the second installment, we looked at permanent participating insurance with the dividend that grows over time as a tool to increase wealth for our children. And in this example, we'll be looking at the issue of building wealth via the permanent critical illness. So as always, the setup of my board is issue, action, and result, which we'll see in the second part of the board. So the issue at hand is, how do I build wealth for my kids and grandkids? I've used the RESP, I've used the participating permanent insurance for my kids or grandkids, and I do have a budget to round out the strategy overall. So what can I look at doing? So the action that we'll be looking at today is the permanent critical illness strategy. So I have another video that you can look at, which I called Critical Illness, the Foolproof Strategy. So it is very similar. The only difference is that foolproof strategy is for usually parents or adults to protect themselves if something happens to them. In this setup, it'll be that we're purchasing this critical illness protection for our children. The idea of this is that this strategy is in sort of a wealth building protection, a wealth building strategy. However, the secondary nature is that it still protects our children against any critical illness for their lifetime. The key to this setup, where the wealth building part comes into play, is the last point here, which is return of, I put a dollar sign, but in essence, the technical term is return of premium. Okay, so if we look at the setup of this protection, parents would purchase the protection, would own it. The insured would be the child. So if something happens to their health, the money would be paid out to the parents to take care of the child. And again, the key is, if your child has an illness, the odds that a parent will want to stay home with that child, the odds are very high. However, a lot of employers might not let parents stay home unless we're self-employed and we have that flexibility. A lot of parents need to continue to go to work, so we aren't able to stay home with our child. If we do stay home, well, we might have to leave our job, or worst comes to worst, we get let go. So there's a lost income for the time that it takes for our child to heal. And we know that financial issues cause stress, and that's something we're trying to mitigate and reduce and avoid altogether. So, but the key here is that we can build wealth in the setup of this strategy by way of purchasing this coverage and hoping that our child never gets sick. So over time, we can call in this return of premium to take back 100% of the money that we paid into this policy. And then once we get that 100% of our premiums paid, we can gift those to our kids, or our child, who is the owner of the policy in the future, can pull out that money and use it for something in the future. So although it doesn't grow over time, it protected our child during the years where we wanted to make sure he or she was protected. But this is the key in the setup, which I'll show you on the board in the next part of the video. So if we look at the way I set it up here, I know the board is full, but as always, I'll go through each line item to show you guys the structure of the permanent critical illness protection. So we start with the protection. So if we buy, for example, $100,000 to protect our kids when they're 3 years old, for example, or just born. Again, just born, after 30 days of being born, we can look at such a protection. The idea is the younger our kids are, the cheaper it is, okay? So at $100,000 of protection, what does that mean? If they do get one of the critical illnesses defined in the industry, there are 25 known in the industry, plus an extra 4 or 5 for juvenile illnesses. They change based on some of the insurers, but by and large, there's 25 plus juvenile illnesses, and the juvenile illnesses last until 25 or 30 years old. So it goes case by case within the insurers. So the correct way to set this up where you never lose your money over time is that we buy $100,000 of critical illness protection. The right way to set it up is we buy it in a term 100, or a permanent protection where they have it until 100 years old, and it's paid up in 20 years. So after 20 years, if our child wants to keep it, or if we as parents want to keep it for life, it is paid after 20 years and the bill ends. Just like the second installment of this series, the life insurance stopped after 8 years. So similar here, after 20 years, the bill ends and we have the policy paid up. So in this example, I put an annual cost of around $1,000. Again, it's going to be case by case depending on the age of the child and the insurers. But just for the example, $1,000 a year. So again, $100,000 of coverage, you have it for until 100 years old and it's prepaid in 20 years. So now, what happens as time goes by? So there's 3 scenarios that can occur in the child's life as time goes by. Let's deal with the most unfortunate one, but the one that is least likely and the one that we don't necessarily ever want to happen. If the child does ever pass away, 100% of the premiums paid would go back to the parents. So it's unfortunate, of course, but it's important to mention it. None of the money would be lost if our child passed away and we paid into this protection. So the money is never lost. Okay, so now that I've dealt with this one, let's cross it off and deal with a little bit more positive situation. So this is the key to the wealth building nature of the protection. So the return of premium if we cancel. So as time goes by, remember that after 20 years, it is fully paid. So the desire to cancel it after 20 years, the motivation to cancel it after 20 years will be low because the policy is paid. However, if we have a need for the cash, we can then call that back. Remember, $1,000 a year times 20 years, $20,000. It's still a pretty chunk of change to be able to do something in terms of wealth building in the future. So I use an example at 30 years old, the child's age, of course, or at 65, or anything in between. Okay, the child can access 100% of the premiums paid in the policy. Now, if the child is not the owner and the parents are, then they control who has access to that money. Sometimes that's important. But if the child is mature enough, the parents can gift that money to the child. And again, like I mentioned, that $20,000 would go to the child to do anything that they wish to do, albeit it should be something that helps build their wealth and continues to grow over time. So you see how the setup, in essence, if the child passes away, the money is never lost. If the child does get sick, the $100,000 would be paid to the child, tax-free, to be able to heal, do treatments out of province, out of country, or how I see a lot of clients use it is one of the parents would stay home, forego their annual income. So say a parent earns $50,000 a year pre-tax income, they'd be able to stay home 2 years without worrying about an income. And don't forget that this is a tax-free benefit. Okay, so it's actually more than 2 years. So that's where I see some of the usages of that $100,000 in our situation. But if the child never gets sick, which is the overall goal, well, when we choose to cancel it after 20 years, 100% of that money comes back to the child to do something else and to invest in something else. A TFSA if they're at least 18 years old, an RSP, a down payment in part on a property. The key here is that the 100% is after 20 years. Anything less than 20 years, it'll be a percentage of the amount. For example, at 10 years, if we cancel it, it's 50% that we get back. It's better than nothing. But after 20 years, that's when we get the 100%. Okay? So, in essence, this is the structure of the policy. The coverage can change. Therefore, the budget can change. And again, the needs here are a little bit more important than just the budget. I would look at the biggest need is for the parents' annual income to be replaced by this coverage if they did want to stay home and take care of their child. If we do want to look at the need to go out of province or out of country, obviously we know that this number needs to be much higher because coverage in the US, for example, for a cancer treatment is well above 100,000. So looking at the need will determine the coverage we want. And of course, we need to make sure that the budget fits that the budget fits our overall budget. So I recommend that you sit down with your planner or your insurance broker to look at your overall budget analysis. Make sure that you can take care of all the other aspects of your budget before looking at something like this. But if we're looking at the wealth building nature of the strategy, if nothing happens in terms of the health of the child, we can call back 100% of those premiums after 20 years. So it becomes a sort of forced savings account where we can get 100% of that money back and then use it as another wealth building piece to the overall puzzle. So the result or the results again of the strategy are that we're protecting the health of the child while we have this protection over time. So in case they are to contract a critical illness, well, the $100,000 would be paid out, and it doesn't deter our financial plan because we would still have this income, and it continues essentially our retirement plan, and it makes sure that we can be there for our child during this tough time. And the other part, which is the wealth building part, is that 100% of the premiums can be paid back or called back by the owner of the policy whenever we cancel it after 20 years. So I hope this video explained the advantages of a permanent critical illness protection with the return of premium on cancellation. So that concludes the three-part series on how to build wealth for your kids and grandkids. Again, if you like the video, please like it. Please click on the notification button for any new videos. And as always, please subscribe to the channel below. It's always appreciated. And as always, in closing, have a great day.